So I'm Henson Orser, and I'm founder and CEO of Soter Insure. And prior to that, I was the first CEO of VARA, the Virtual Asset Regulatory Authority that the government of Dubai set up just down the road. And I came and helped them in 2023 as the first CEO to launch basically the first global virtual asset regulator. Prior to that, I was president and acting CEO of Komainu, an institutional-grade custodian that we spun out of Nomura in partnership with CoinShares and Ledger when I was a senior executive at Nomura. When we stood up Komainu out of Nomura, we spent a lot of time thinking about licensing because we wanted to be a licensed, qualified custodian for financial institutions to be able to hold digital assets with us. And so we spent a lot of time thinking about who has good licensing, and there wasn't much anywhere. And then also, how could we get insurance for our clients so that financial institutions could feel comfortable that essentially their assets were safe and be comparable to other qualified custodians. I went on from there to help VARA set up in Dubai. And in 2023, we launched with the first rule books, framework, guidance, all that sort of stuff, issued license, and began supervising and enforcing. One of the things we required was that all our VASPs who were getting licensed get insurance. So D&O, PI, so it's directors and officers insurance, professional indemnity, but then also crime and specie, loss of asset insurance if they were holding assets on behalf of clients. And then also we're looking at slashing insurance for professional staking as a service providers. And what we found was it was hard for them to get insurance, both in the UAE and from the traditional providers. And when they could, it was prohibitively expensive. So we thought somebody should start an insurance company. And with the support of further ventures here in Abu Dhabi, as well as WebN out of London, which is a Brevin Howard venture incubator, we stood up this insurance company called Soter Insure, an Abu Dhabi holdco, and a Bermuda opco. So we offer all those different types of insurance to financial institutions who deal in digital assets. But our novel approach, as we were just talking about, is not only can we underwrite in fiat, traditional dollar coverage, but we're underwriting in Bitcoin and Ethereum as well. So for people who are holding a bunch of Bitcoin, or wallet providers who have clients with a lot of Bitcoin on their platforms, we can offer them insurance protection for loss of Bitcoin rather than just dollars. And obviously, relative to dollars, Bitcoin is a volatile instrument. And so to have a better asset liability match on your potential losses makes an infinite amount of sense to everybody. Well, there's a couple of things because the traditional insurance providers aren't necessarily licensed to issue insurance into the UAE. Also, the very traditional insurance providers didn't really want to or need to or understand how to touch crypto. Now, this has evolved, obviously, and there is capacity. But where there is capacity now, it's generally denominated in dollars. And we're the first to be offering it in Bitcoin and Ethereum as well. Well, so for the regulated sort of C5 providers, and just call them like broker-dealers or exchanges, custodians, they are getting capacity. It's de minimis. I mean, less than 1% of all the Bitcoin that's in custody is insured. But what we're also seeing is insurance pools being developed for DeFi as well. So say some of the borrowing and lending protocols, in order to encourage like retail adoption as opposed to sort of, I'll call it the sophisticated crypto bros who have their own wallets and can get access through MetaMask and understand the platforms and get their yield. I think for broad retail adoption, the industry has to marry Web 2.0 with Web 3.0. And part of that is going to be insurance pools, just so people who don't understand the technology platforms, don't know how to evaluate them, but maybe want to get yield on their stable coins, know that their deposits are safe. And so I think that that's going to be a new development is almost like depository insurance for retail to feel comfortable on starting to use these platforms that really is the most sophisticated folks who have been participating in DeFi so far. historically, but the same way that individuals in a sovereign country don't have to do deep credit work on the bank when they put their deposits in there. They know if it's a regulated bank, their deposits are safe. And to get broader adoption, both from retail and from financial institutions in the space, I think they're going to have to be insurance pools, even though the technologists believe in the technology. But one thing I'll also add is there's all this demand for insurance, but also when we issue, say, insurance policies denominated in Bitcoin, we have to hold a bunch of regulatory capital against that. And so we hold a bunch of Bitcoin in order to be able to underwrite and satisfy capital solvency rules with the BMA. And this is also an opportunity for other folks, the supply side of the equation, to get yield and return on their Bitcoin. So it's using Bitcoin as a store of capital as well, not just a store of value. And if we underwrite well and the premiums are more than the claims, then we get essentially like insurance or reinsurance returns on the Bitcoin. And, getting yield on Bitcoin right now is all the rage. And this is a diversified, different way of getting good risk-adjusted returns on your Bitcoin. We're going to tokenize that and then make it available broadly for people to get, insurance yielding Bitcoin tokens, which will be very exciting, as a longer-term plan. In Dubai at VARA, we took an interesting approach, which is we didn't bother to with the taxonomy of declaring something a commodity or a security and then having a commodity or a securities regulator supervise it. We just called all virtual assets, and every operator had to have sort of a minimum level of operational compliance to be FATF compliant and have auditing and reserve customer assets away from their own and anti-money laundering, onboarding, offboarding. Everybody had to comply at a certain very high level. And then we had rule books for whether they were a broker-dealer, exchange, or custodian, and ultimately wanted to get to the same outcome, that if another jurisdiction decided to declare things securities or commodities and have the securities regulator or the commodities regulator, that at the end of the day, you're getting the same outcome of all the investor protections that you want for a safe ecosystem. So I think it's doable now, actually, with, just call it AI or large language models, to compare all the different regulators and make sure that it's strong local jurisdiction as individuals go into these global platforms, whether that's a global order book or a global borrowing and lending protocol, or even going into games that have 2 billion users and there's exchange of value. We have to figure out a way to, in the network state, have local supervision in order for people to get inside the sort of Web 3.0 walled garden and have investor protections. So I think that at this point, as everybody's advancing different approaches, but trying to accomplish the same things, it'll be to harmonize that. We'll have to talk about passportability, equivalence, digital corridors. The Central Bank of UAE is working on this with other jurisdictions. And I think we'll want to sort of harmonize that, because you do want to have local regulatory capture for bad actors, but give the benefits of global technologies to the world as a whole. It's hard for people to sort of differentiate between the different technology platforms and how people are operating, but some very core principles in sort of Web 2.0 finance is some of these protections. And I'll go once again with like the deposits are safe, or not front running in public markets. All sorts of things people think about and actually just they don't think about because they know they have those protections. And so knowing whether your deposits are segregated and bankruptcy remote versus being used for something else. I mean, there was the opportunity for fraud back in 2022 when, a very large exchange was operating and people had trust towards it. And it turned out that that trust was betrayed. And for the maxis who, have their own MPC wallets, their own keys, they understand DeFi, they afford the protections and understand the networks and the sanctity of those. That's great. They're sophisticated, caveat emptor. But the whole next level is going to be about broader, both retail and institutional adoption. And people won't have that sophistication if they're just opening up an app on their phone. And that's where we have to work very hard on making sure people are protected to get the benefits of Web 3.0. For us, as I said, less than 1% of the Bitcoin that's held in custody is insured, and there needs to be a solve for that. If, say, at a large exchange, it's all being held ultimately by one sort of master key or supervision, those are very large pools that are hard to insure, because if they do get ruptured, there'll be staggering losses that'll dissolve people. But we have to figure out how the risk is diversified. We also have lots of people who have Bitcoin who are looking to get return on it rather than just hodl or lend it unsecured to get a little bit of extra yield. So, our challenge is going to be putting those two together, not only on sort of the custodians and the licensed broker dealers, but then rolling out some of these insurance pools to DeFi and some of those protocols as well.